Thank you very much. Thank you for coming and thanks for having me here in Marseille. I'm very happy to be here. Yes, I'm going to talk about this paper, Does Global Financial Transparency Improve Tax Compliance in Developing Countries? It's joint work with Lauke Larsen, who was a PhD student of mine in Copenhagen, and Nadine Riedel from Münster. And so at some point, this is like a paper about kind of a very particular type of tax evasion, so people evading taxes through offshore bank accounts, and about a very particular kind of policy intervention that tries to rein in this kind of evasion. So that's like a policy that that gives countries information about like the accounts that its residents have abroad. But it also kind of, at least the results made me think a lot, like in more like general terms about kind of the information that tax authorities acquire and how they use it, and kind of the equilibrium that results, like where like with some evasion and some audits, like some enforcement effort. And so I'll try to kind of at the end get back to that, kind of take a step back and say like, what do we actually learn from this in more general terms, if there is time. All right, and please feel free to interrupt at any point, like with questions or comments. It's very kind of work in progress still, so like it can still be shaped by your comments and ideas and suggestions. So the starting point is this. So there are a number of papers showing that households all over the world have a lot of money in offshore tax havens. Most notably kind of the very wealthiest people. And just to put some numbers on that, so like the pioneering paper by Gabriel Zuckman shows that something like 10% of household global offshore wealth is held like offshore. So I have some paper with him and with others showing that, some using microdata to say like, so who actually owns this wealth? And we find, for example, in Scandinavia that around half of the offshore assets are owned by the top 0.01% of the wealth distribution. So like extreme concentration of this wealth at the very top. Now, the good news is that policymakers actually seem to have been taking this seriously. So there has been this global policy response. This is what I call global financial transparency, which is automatic exchange of bank account information. So this is more than 100 countries that have started, including all like major financial centers, like Switzerland, Luxembourg, what have you, have started cooperating in the sense that banks are now they have to find out like what accounts are owned by foreigners, and then send information about like that account, like balances, income flows, and so on, to the home country of the account owner. All right, and so information about more than 100 million accounts is being exchanged every year across borders, and these accounts have a total value of more than $10 trillion. So like it's really like a very, very ambitious policy intervention that is it's kind of basically doing what any theorist would say that should be done, kind of without kind of regarding too much the practical problems here. And so one way so this is very ambitious, and one way to think about it is actually that what it's doing is it's extending something that we know very well from the domestic domain, which is third-party reporting, to the offshore domain, right? So we're used to employers. We have a salary. Employers tell the tax authorities how much we made, right? We have money in the bank tells the government like how much interest income we had on our account. So now this is the same idea, saying we need kind of the third parties who have little incentive to misreport, to tell us about the income and the wealth of our taxpayers, even if these banks are kind of in Cayman Island or in Switzerland or in Singapore or wherever. So kind of global third-party reporting, right? Now, so why do I stress this third-party reporting so much? Well, because third-party reporting is really at the heart of kind of modern theories of tax enforcement, all right? So in particular, due to a couple of papers by Henrik Kleven, Klaus Kreiner, and Emmanuel Sais, showing that like how important the third-party reporting is. And so it's very intuitive that if you just ask people how much income do you have, they might give you like an answer that is not truthful. But if you ask a third party who knows how much income you've had and has no incentive to misreport, then you have a much cleaner picture of people's true income. And so these papers, I mean, maybe you already know them, but so they show empirically for Denmark that if you look at kind of randomized audits, you'll find kind of, and it's mind-blowing, but you find that when you go and look, I mean, so at people's reporting, you split kind of people's income into income that is third-party reported, income that is just only self-reported. You find non-compliance rates that is around 100 times larger on the income components that are not third-party reported than those that are third-party reported. Okay, so like around 30% for the non-third-party reported and around 0.3% for the third-party reported income. So mind-blowing and super important, of course. And so actually, so what this kind of suggests is that you can imagine that there will be like an equilibrium here. Think of an equilibrium as like tax authorities playing, Nash against taxpayers, where there's very little audit effort and still kind of full compliance. So how does this happen? Well, tax authorities say whenever we find a discrepancy between, like people's self-reported income and the third-party reported income, we're going to audit it. Right? That means, taxpayers think, well, whatever, if I report something that is not true or that is too low, I'll be audited, so I'll be compliant. And that means that there's actually no non-compliance to find, so there's no audits need to be conducted in the equilibrium. So this is like a fantastic equilibrium, kind of from the perspective of like government administration. And so the question that I'm going to be asking now, like in this paper, is like, so when you do what we just talked about, kind of extend, that automatic information exchange, or when you introduce automatic information exchange, extending third-party reporting to this global domain, do we then put an end to offshore tax evasion? All right, because this is the promise, right, that we get from this theory, and if not, why? And so the main part of the talk, and possibly the only one, if you have a lot of questions and we will be slowed down, will be empirically. And so the setting here will be South Africa. I'm going to use administrative data to investigate how, like the onset of this automatic information exchange, how it shapes the compliance behavior of taxpayers, but also the enforcement policies, or in particular, kind of the audit policy of the tax authorities. And so the two questions are here. So when this information from banks all over the world start arriving in South Africa, do people whose bank accounts are covered by this information, do they stop evading tax? Do they start reporting their foreign income when the information kind of arrives in South Africa? And secondly, do tax authorities actually do what the theory tells us they should do? Do they actually kind of systematically audit these discrepancies between self-reported and bank-reported foreign financial income? So these are the two questions. And so the answer to the first question is, just to give you a preview, is, well, some stop evading, but definitely not all. There's a lot of kind of non-compliance on foreign financial income left, even after tax authorities presumably know about this foreign financial income. And so that's a bit surprising in light of the theory, and then the answer to the next question is then also no. So the answer, the finding here is that, well, tax authorities do not kind of systematically detect like all the instances where people report less foreign financial income that is, reported by the foreign banks. And so in light of this question, then this becomes, that makes sense, right? If I don't think the tax authorities will actually use the information they receive from foreign banks, then I might consider continuing evading. But now, like, the puzzle is this one. Like, why don't tax authorities kind of to a great extent use the information they get from foreign banks to, find these discrepancies and audit them? And so at this point, you could start thinking, well, maybe they just don't understand, they just get it wrong, and so on. But what I'll do at the end is kind of to think more carefully, like, about this problem. Like, so So what could explain? Can you think of a kind of an equilibrium in a sense where third-party reporting and tax evasion kind of coexist, where it's kind of it's an equilibrium of sorts?
Just for clarification.
Yeah.
So when you tax evasion, that's the combination of putting your money in foreign banks plus underreporting.
Yes.
And so you're observing both, right?
Yes. So it's true that it's not tax evasion just to have like income in Luxembourg, but it's usually tax evasion not to self-report that income. Okay. And it's true that now we get information about like from the foreign banks about what we say like is your true foreign interest income and dividend income and so on. I can see on tax return what you have self-reported, so we'll think of the difference as being non-compliance. Okay, so this is where again at the end like of the empirical part, I'll hopefully get back to this like this theory part where I'll try to think theoretically about like how tax evasion and audit policies are kind of jointly determined in an equilibrium. And the basic question is this: like, so if tax authorities really get third-party reported information, how can you then have an equilibrium where still they don't use this and taxpayers like are still non-compliant? And so the analytical ingredients, that just to give you a little taste here of or a flavor of what I'll be doing, is that I need to throw in some ingredients. And so the two things that are key here is, so once that third-party information is not always kind of completely accurate. In particular, like in this setting, it's going to be kind of more like a noisy signal about people's true income than actual kind of the fully perfect truth about people's foreign income. That's one thing, and that's kind of empirically founded. We'll see that in a second. And also another thing that I will assume here is that audit policies need to respect a time consistency constraint. So what do I mean by that? Well, you can imagine like tax authorities saying 1 year, we're going to audit all tax returns really thoroughly. And all the rational taxpayers will say, well, given that audit policy, I will be fully compliant because like I know that if I evade, then I'll be caught. And then all the tax returns will arrive. And now it is no longer kind of optional for the tax authorities to do all the audits because there's no like evasion left in them, right? So that would be an example of like a time inconsistent audit policy. I say I'm going to audit everything, people are compliant, and then suddenly it's not optimal for me ex post to actually conduct the audits. So in my little model here, I'm going to impose this kind of this time consistency constraint, which really means that you need to think about not a Stackelberg equilibrium where tax authorities can just say whatever, like, and then taxpayers respond to that. But we're going to be looking at a Nash equilibrium where what tax authorities do in terms of audit policy has to be optimal given what the taxpayers are doing, and vice versa. All right. I don't think I'll spend a lot of time on literature. I'll just say, so this automatic information exchange really is kind of a big like a nuclear bomb of kind of enforcement in this field. But so of course there are predecessors and there are like policies before that, and so there's work showing that it didn't work so well. There are limited compliance effects of these earlier policies. There are a number of papers that study kind of unintended behavioral responses to this government intervention. So there are papers showing that people have tried to shift deposits around in order to like avoid find the few pockets of tax havens that didn't participate for a while. Segal has a great paper looking at people who are kind of like who avoid the reporting on their financial assets, move into property, to real estate assets. In response to that policy, and then another one like here that showing that some people have tried to get like another passport in order to avoid the reporting. That if you could kind of tell your Swiss bank, well, actually I'm not French, but I'm from St. Lucia, like in the Caribbean, like and show your passport from over there, that would be a way to avoid the reporting. And then there are a few papers here, like about kind of like the compliance effects of this information exchange, which is like more in the vein of what I'm doing here. In particular, so I have a paper from Denmark where we like clearly have like better data and in a like a better setting in a sense, like for studying compliance effects. So I think what makes this paper different is first that it's like a developing country setting where both like the resource constraint might be different, the tax authorities, and also the political economy might be different. So there are different reasons to think that this could play out very differently in developing countries. And also kind of this step here that we are kind of looking at like directly at kind of what do tax authorities do with the information that they receive in terms of like incorporating it into their audit policy. Okay. Questions? Yeah.
And when you interpret the CRS data as a noisy signal of true income, is it specific to developing country context or in other papers, like looking at the effect of this policy in Denmark or Switzerland?
Yeah, I think that it's a general thing. Like so, okay, so that's a great question. So in a part of this Danish paper that, or a paper from Denmark, we actually, as a part of that is an audit collaboration with the tax authorities, where we are specifically saying, well, look, let's find all the taxpayers who have a discrepancy between, you know, what the banks say they have income, what they say themselves. Someone who has like Swiss banks say they have 1 million of income, they say they have 0 of themselves. And let's kind of take some of them out randomly and audit them and see what's going on. And it turns out that it's not all evasion, that there are cases where, you know, like you do have this discrepancy, but in fact it is sometimes due to, for example, to errors in the reporting.
And
Yeah.
something related, an implicit dimension in your theoretical framework is the severity of the sanction if
Yeah.
you get caught.
Yeah.
So I guess it varies across countries, right?
Yeah.
So how should so what is the situation in South Africa,
Yeah.
and how should I think about this?
So this is really embarrassing. I just don't know. I think that all countries have some kind of penalty, like, and I should get into these details.
Because if it is not super costly,
Yeah.
then why should I start
Yeah.
evading?
Yeah. If the penalty is low, then wait until they find me, then I'll pay the little penalty that there is. Okay, that's a great question. Thank you.
And related to this, like I was curious if it's differential compared to the fraud or the like compared to the tax evasion that I did. It's if the punishment is going to be differential. You see what I'm saying?
No. Sorry.
So if I did, so if I misreported a lot, am I going to be punished more? Or?
Yeah. So that's the typical case, that there'll be like even a de minimis thing, you know, where like there's no penalty, and then there'll be like a progressive kind of penalty schedule. And like, so for example, you can go to prison in cases like this, but only if amounts were really big and it was intentional. So I guess this intent is also sometimes a margin, but I'm embarrassed to say that I just don't know like the particular rules in South Africa. Yeah.
Also then talking, since you mentioned the golden passports, is like the income distribution, like thinking about South Africa, is there like a difference in the sense of that the high income people are more like international, they're more likely to also have double nationalities, more likely to be like globally dispersed, and for example like the country where Denmark, where I just have a different view of
Yes, I mean, so in principle, so it's possible. So so now all this is going to be based on people who are kind of fully tax resident in South Africa. So that doesn't mean that the banks could not get confused, and you know that taxpayers could like try to make banks confused. But I don't think we have a good way of getting at that empirically. But I think that's as you'll see, like so one problem in this data, for example, is that South Africa received many reports that either that they cannot match to taxpayers, and that's often because there is no taxpayer ID number that banks just omitted somehow. But it could also be, I mean, because of some confusion with respect to nationality, I guess. All right. Yeah, so these are just kind of examples of like, so this idea that like this third-party reported information is not always kind of, it's not always perfect information, that there can be noise in that. So there are some other examples of that kind of in the recent literature, like on third-party information. So let me just say a little bit more about the bank background here. So again, so what is this policy about? Well, it's a big group of countries have agreed to exchange information automatically about bank accounts. So again, so banks need to identify the accounts that are beneficially owned by foreign residents, and then share the information about account balances, income flows, and so on with the foreign, the home country of the account owner. Importantly, like, so you think, it's easy, I can just kind of set up this with some complicated ownership structure and then they won't find me. But in principle, like, so layers, for example, like of corporations between you and the account doesn't help in principle. Like the banks have to then look through like these corporations until it finds like this the beneficial owner of the account. And there are also rules that are, you know, targeting trusts and kind of other legal structures that you can do to conceal, you know, that link between the account owner and the account. Yeah. So one, I think, interesting background fact here. So now this is a paper about South Africa, which is an upper middle income country. So this shows you kind of the participation in this global policy here, or this information exchange policy by income group. And you can see that kind of almost all high income countries are part of this. But there's a strong income gradient, so actually there are no low income countries that are part of it. And for like an upper middle country like South Africa, it's kind of a 50-50 whether you're part of this or not. So I think it really, so you can think of this in different ways. So one is, you know, that there's clearly an entry cost into this regime, that in order to receive information from foreign countries, you also need to, you know, roll out this regime domestically and have your banks kind of detect or like try to find out where the account owners live and provide information to these foreign countries. So that might be just like too steep or too complicated in some contexts. But it could also be something about, you know, what are the perceived benefits here that might actually vary a lot with the income level. So it could be that if you are lower middle income country, you say, well, I don't really have resources in my tax administration to use this information rigorously, so then, you know, then it's not really worth it for me to participate in. But we are here with South Africa. Okay, so the data that we're using basically come from 3 different places. So there are data on tax returns, and South Africa luckily like has a very kind of granular tax return where we can basically see very detailed income categories, including, for example, foreign interest income, foreign dividend income, foreign capital gains. And the great thing is that these categories kind of map, or at least some of them map directly into like the income categories on these automatic information exchange returns. So we can really compare like category by category whether whether people report the same amount of money that or income as the foreign banks say that they have. Those are tax returns. We can merge them on these information exchange reports from the foreign banks. That again, they have information about account balances and financial income. As I said, like for these 2 income categories, they map like nicely into each other. That is interest and dividend income. The problem here is capital gains, where basically on these reports here you don't see capital gains. You see gross proceeds, which is like the amount that you earned, if you want, like by selling assets, but not like in a gross and not on a net basis. So it doesn't deduct like the costs of buying these assets previously. So we don't have a way of comparing capital gains. Another important thing is the one that we just mentioned, that there is that not everything matches. All right, so they are kind of that they are only in the country, I mean, so in 2019, for example, only 60% of the total account balances that we see in these reports actually like map into like an owner like in South Africa, a taxpayer with this, and that is mostly due to just lacking TIN numbers. That banks don't always report TIN numbers. The final data set here is like audit data, where we see information about like all the audits conducted in South Africa and also how long they took. There'll be kind of a proxy for like the thoroughness of that audit, and also the ultimate correction, but not kind of in a granular way. We cannot like see what income flows that they apply these corrections to, but just the total correction. And I think so. This is just basically, yeah, making the point about the kind of imperfect matching. So I think that's kind of one way to just say, well, look, this is a setting where third-party reporting is not kind of comprehensive and precise information about like your true income, but it's really like a noisy signal about your true income. So 60% kind of match rate, mostly due to missing TINs, and this is not just because South Africa is screwing up. This is kind of consistent with other countries' experience, as actually the OECD is keeping track of kind of like these match rates across different countries. Okay.
Is there some systematic differences in this misreporting?
Yes, a little bit, and it goes in the way that you would hope. So it's not that kind of that the large accounts in tax havens are miss a TIN. It is more the opposite. That is kind of it's old accounts, dormant accounts, for example, are more likely. Small accounts are more likely to not have a TIN. So it doesn't really suggest that there's any like intentional selection into not being reported on.
And not systematic differences across countries, or?
There are definitely systematic differences across countries and also across banks. So like, and actually like across countries, it's kind of a continuum. So you have like countries with, I mean, at every kind of, like the share of reports that can be merged on kind of varies from 0 through 50 to 100%. And at the bank level, it's more kind of either or. That is really like, it seems to be the case that some banks just like dig a bit deeper and like get these TIN numbers, and others do it less.
And, sorry,
Yeah.
do we have a sense whether taxpayers are aware of those differences? If I know that this bank will do a poor job reporting for whatever reason,
Yeah.
then my motivation to tax evade my income.
I think taxpayers should be aware when third-party reporting starts, because so the typical case is that the bank will need to tell you that, okay, I mean, now I'm reporting to your tax authority about like the information that I have on you. Are taxpayers aware that, you know, like to what extent information can be matched or not on other taxpayer info, and you know whether they, I don't know. I suspect that some, I don't know.
Are there some penalties on banks if they have a low or bad report by the government of South Africa?
No. So that is impossible. So the South Africa cannot kind of issue fines to Swiss banks for, you know, not doing what they're supposed to do. And so now we're getting a bit into the weeds of this, and I didn't actually plan to, but actually, so here, this is an example of a term that you might, I think, get to hear more and more, which is like it's a side-by-side regime where kind of the US has its own policy that's called FATCA, and the rest of the world has its own policy called the Common Reporting Standard. So the US was a first mover. They said, we want information exchange. We set up this regime called FATCA. The rest of the world followed and made something very similar in the Common Reporting Standard. So the U.S. has penalties. So the U.S. and it's set up in the term as withholding taxes. That I can say like if there's a foreign bank that doesn't comply with U.S. rules, they can impose really kind of steep withholding taxes on kind of all income flows to that bank. So a really big stick. The policy of the rest of the world doesn't have that kind of stick, but it basically says it's every country's responsibility to make sure that its banks are compliant. And the OECD is helping, like sending like peer review people like out and like checking whether things are working well, but there's no possibility for South Africa or France or other countries to punish like foreign banks directly. So the US can do that. Okay, that was an institutional deep dive. Yeah.
In the theoretical treatment of the question of the issue, it might be important.
Yeah.
To produce,
Yeah, I mean, so I think if you're really worried that the problem is that banks don't do what they're supposed to do, then I think we should think more about how can we discipline banks. So I'm not. So it could be. So in the again Danish project, we do have like a way of trying to quantify the assets that should be reported and don't seem to be reported. We find a number of something like 17%, but really decreasing over time, suggesting some kind of learning rather than like intentional like non-compliance by banks. But I agree that until we really know where the problem is, then there's a possibility that we should invest more in sanctioning banks that don't do what they should do. And of course, you could be, depends on a bit on your instincts here, because you could say, well, why should we believe that Swiss banks who've been helping tax evaders evade for a century, that now suddenly they become like enforcement agents? That's one perspective. Another perspective is that like all of these tax havens, actually they are kind of really well-governed countries with a lot of financial supervision and so on. And so that should make you think that maybe when the Swiss government says, well, you have to do this, then they will do what the Swiss government tells them.
In contract theory, where there is a principal, the agent, and a third party, it's always a problem. How could you incentivize the third party to collude with the principal and not to the agent?
Mm-hmm.
So it is really.
Yeah. Sure, but so one perspective is, okay, well, there are 100 million reports being sent every year, so like they do something, right? And they do have information value, these reports and so on. So is it complete? Is it comprehensive? Well, some evidence suggests that it's getting better, at least over time, the quality of the information being sent. Yeah, Sigal?
So when you say the quality is getting better over time, do you mean the quality of the data sent by which bank? Because we can think that maybe for non-haven countries, the bank have no incentives to misreport, while for the banks in tax havens, they do have incentives to misreport in order to keep their clients.
Yeah.
And do you see that the quality is also improving for banks held in located in tax havens?
So I think the level is kind of so again, in our Danish study, so then we can actually, by country, we have a measure of kind of like the misreporting by banks, if you want. Like how many assets do they report? Do they not report that they should report? And that seems to be slightly better for havens than for non-havens, which is consistent with kind of other, I don't know if you know the papers by, what's it called? Jason Sharman, where he's kind of sending out letters to different offshore incorporation companies and said, I would like to set up an anonymous holding, and then like it's an RCT, and then he finds that kind of that actually so the chance that like a corporation service provider will say, okay, I can do that, although it's illegal, is bigger in the US and the UK than in tax havens. I think there is evidence, and this is consistent with this, that actually the information might not be kind of worse in tax havens, surprisingly maybe. Okay, let's have one brief look at the summary stats here. So this is just like, so there are around 15 million registered taxpayers here in South Africa. Around 135,000 of them, they get matched to one of these reports that South Africa receives from foreign banks. And not surprisingly, they are very different than those who don't get matched to such a report. So they are like have 5 times higher income in general, but they also have like between 50 and 100 times more financial income. So they're just much wealthier people, which is, of course, not surprising. So the first thing we do in the paper, and I didn't talk much about that in the motivation, is just to say, well, how much wealth, how much offshore wealth, how much foreign financial wealth do South African households have, and how it's distributed. So I think there are a number of papers now who are doing something like this. So I won't talk so much about it, but I'll just give you kind of a sense. So now, over time, what happens? Well, so the dotted line here just shows you like the aggregate of all the account values that South Africa receives information about, owned by South Africans. So there's some kind of phasing in over time of like this information. So that drives some of the trend. So in the thick black line here, we're just trying to adjust for that and say, so what is kind of our best estimate of the total foreign accounts that South Africans have in foreign banks. And that goes from so in the last couple of years here, it goes from it's around $80 billion. All right, it's kind of the total value of these accounts according to our estimates. If you're willing to assume, like that we just talked about, that there is some fraction of accounts that are not being reported on, that will get you to around 100 billion. If you applied that number that we find in the Danish study to this, you'll get like a slightly higher number. And then the colored bars here gives you the distribution across like 3 types of accounts. So like the blue one is personal accounts in tax havens. So that's kind of 2/3 of all this money is held in tax havens. The red bars are personal accounts in non-havens, and the green bars are like personal holding companies, which is like surprisingly small, I think, in the South African context. So it seems that most of this wealth is really kind of like directly held in a tax haven like Singapore, Cayman Islands, Jersey, Switzerland, Luxembourg, a place like this. Okay, so around $60 billion in 2020, say. So that is pretty high, like by 2 comparisons. So one, like for example, so Gabriel Zuckman's estimates suggested that something like that global offshore assets were around 10% of global GDP. So this is kind of 2.5 times larger. This is like 25% of GDP, which is maybe not so surprising. There's a lot of cross-country variation here, and this is like a relatively low income and also like a very unequal society where you just see higher offshore wealth holdings. Just briefly to mention kind of, and this comes back to some of this literature we talked about before, that so there are asset classes that are not covered by this information exchange. So for example, real estate that Segal has been studying, so like that's a way our estimate here does not kind of account for apartments that South Africans own in London or New York or elsewhere. It also doesn't account for crypto, and unlisted shares typically are also kind of not part of this reporting here. So if you wanted to get to a grand total of South African wealth in foreign countries, you'd have to add some of that. So it's a conservative estimate in a sense. And now a little bit on distribution. So this is just basically the probability along the income distribution of being matched to an account, and you can see that it goes from 0 for most of the distribution up to around 25-35% in the top 0.1%. So like a very strong income gradient and pretty high levels also like at the top. So it's kind of common for rich South Africans to have foreign assets. And again, this is lower than the true probability because of the mismatching, right? That kind of all the guys who have an account but are not matched to it because of the missing tint or whatever, they don't contribute to this level here. If you look at it a bit differently and say like, so what share of the total South African offshore assets belong to different income groups, you get this picture here, and you can see kind of that again. People down here have very small shares, and then when you move to the top 0.1%, they have around 20% of total South African assets. So like a a high concentration, but actually kind of less concentration that you'd see like in other studies and what we found in, for example, in the US, like based on very similar data. Okay, so I won't dwell so much on this, but this, if you're interested in kind of in wealth distribution or like, so this is, we think that contributes a little bit, but it's kind of, it's in line with, you know, what we have found in other studies, that this wealth is highly concentrated, but actually a little bit less so in South Africa than elsewhere. So let me talk about compliance. So about, you know, what happens to taxpayer compliance, taxpayer reporting of their foreign financial income when this information exchange turns on. All right, and we'll start with some analysis at the aggregate level, just looking at time series, basically. Yeah, so I'll do two things. So first I'll say, yeah, so what I just said, what happens to aggregate self-reported foreign financial income when information exchange starts? Is there a compliance response? Is it the case that people suddenly report more foreign financial income? But then also comparing that aggregate, you know, self-reported foreign financial income to the bank-reported number, and, you know, thinking about how much is left and how much less do people then still self-report than, you know, banks say they actually have. So this is just a time series of the aggregate foreign financial income reported by South African personal taxpayers. And you can see that there's a pretty like stable level up until 2015. So the first information exchange happens in 2017, but, you know, with respect to the tax year 2016. And you can see that just exactly in these 2 years here, you see kind of a level shift where you get basically kind of a doubling of the self-reported income that South Africans put on their tax return related to kind of to foreign accounts. All right, so suggesting something is happening. This really suggests that there is a compliance response. Some people choose to self-report more. Just to understand, so where does that come from? I've done like a very simple exercise here where I say, well, let's just, within different ranges of foreign financial income, let's just count how many taxpayers that report in that range, okay? So this gives you the number of South African taxpayers reporting foreign financial income that is bigger than 0, but less than $100. People who have like really kind of small accounts and small like income numbers. And you can see nothing really happens to that series around like the onset of information exchange. If you go to a slightly higher range, so between $100 and $1,000 of income, you see roughly the same pattern. If you go to a slightly higher range, $1,000 to $10,000, you get roughly the same outcome. When you go to a slightly higher range, you get like a little more action. So now this is between $10,000 and $100,000 is really not negligible. You do see an increase of something like 50%, like at the time of that this information exchange kicks in. But where you really see the most action is people who have like large, or relatively large foreign financial income. So these are people who have more than 100,000 people of self-reported income, that sort, and that actually, you know, increases by like 150 to 200%, like in these 2 years where kind of this is being phased in. So that kind of increase in the aggregate really seems to be coming from people who have relatively high flows of foreign income into their accounts. So this is positive, right? It really suggests, well, there is a compliance response. It is concentrated where we want it to be, kind of among the people who have, you know, significant wealth and financial income. Interestingly, it's the complete opposite of what we see in Denmark. So in Denmark, there's also like a huge increase in the number of people reporting any foreign financial income on their tax return, but it's all driven by people who have like tiny amounts. And I have not completely wrapped my head around, you know, like why that difference is, but something really plays out very differently in this South African context. So now brace for the bad news, because now we're going to compare this, which is like the self-reported, aggregate self-reported income, to the aggregate bank reported income that corresponds to this number. All right? And this is what you get here. So now the blue line is what you saw before, like that you see kind of a doubling of that self-reported foreign financial income. But the red line is what the banks are saying that people have on their accounts. All right? And that is kind of so we cannot go back kind of from before this policy started. So we only can start to do that like reasonably well in 2017. But you can see that there's still kind of a huge gap, suggesting that around 50% of kind of the true income on these foreign accounts is being self-reported. Right? That there's a gap here of roughly 50%. So that was the bad news, that there still seems to be a lot of non-compliance left. And despite the fact that there is third-party reporting, that actually that South African tax authorities actually know like who has this missing income. Yeah.
So this is interest and dividend only, or?
No. So here it's interesting dividends and capital gains, but what I'm imputing capital gains by just assuming that there's the same ratio between capital gains and dividends in the bank accounts as in the self-reported income.
Okay.
But we can do it just for interest and dividend, where you see everything precisely and you get the same qualitative picture. It's just like the gap is slightly smaller. All right. So just to answer these questions here, so what happens to self-reported foreign financial income when this information starts flowing to South Africa? Well, we do see significant compliance responses. There's a doubling of this self-reported income, but there still seems to be significant remaining underreporting. Taxpayers report only half of what we think that that true foreign income is. Maybe I'll just skip this one. Now we can go like to the taxpayer level. Like this was all time series and aggregate, so that we can do a little bit better in terms of identification, I guess, if we go to the taxpayer level. And here, so there's at least one thing we can exploit, which is that there's kind of a staggered adoption of this policy, because like so countries joined in different years. Okay, so the first countries again started reporting in 2017 with respect to the tax year 2016, and then some countries started only reporting in 2018 and others in 2019. So we can use that a little bit. We're going to focus on the largest cohort, which is the 2016 cohort. It should be 60 billion. So 60 out of the 80 billion comes from that large cohort. And so then, so we're going to focus on that, but we'll also look at the next two cohorts. And then we're going to just to get a traction on this, we're going to distinguish two kinds of taxpayers. So those that already in 2015, so before the information exchange kicked in, had some self-reporting of foreign financial income, and we'll call them the ex-ante compliers. We don't know whether they reported enough, but at least they reported some. And then we'll compare those to the two taxpayers who did no self-reporting in 2015. So immediately before tax authorities get this report saying, well, you have all this foreign income, they had no self-reporting of their foreign income. And we call those ex-ante non-compliers. So now let's look at the ex-ante compliers first. And so the red line here is kind of their average self-reported foreign financial income. And now it's only interest and dividends. And the black line here is then the bank reported foreign interest and dividends. And you can see that, so it seems we don't only observe kind of the black line from when reporting starts, but you can see from that point it really seems that people are fully compliant, that the two lines roughly match. And there's nothing here suggesting that there's any compliance response in this group, that they were compliant and they continue to be compliant through this time window. Now, if we turn to those who were kind of so ex ante non-compliant, so just be aware that kind of by construction, they have a 0 here. We are kind of conditioning on having no self-reporting in 2015. Then we see also a jump up like in 2016. So there seems to be a compliance response. But this group like seems like they remain like far, far below the black line, which is again like what the banks say that their income is, right? So, so this compliance response here comes from a group of ex-ante non-compliers that that do not become fully compliant, or at least not all of them become fully compliant. There still remains a lot of non-compliance in this group.
And here you mix every account, like no matter the amount, no matter the amount. You are mixing
Yes,
everyone.
yes.
And if you look,
But I can only look at people where there is a match, right? So I cannot. Yeah. So I have to throw away.
yeah, sure.
yeah.
But did you try to separate based on the the amount?
No. Yeah. Good point. Like so, because the other results suggested that this response is bigger for. Yeah.
Probably.
Yes. I'll do that. Yeah. And this just to show you kind of that blue line here. So that, again, that's all based on the 2016 cohort, where like the first cohort that is treated by information exchange. If we look at kind of the next cohorts, like 17 and 18, you see like a similar like qualitative pattern, but just like a slightly more noise because they are the cohort size is only like 1/4 or 1/6 even like of the first cohort. All right, so where are we? So so we've I think found, so our results suggest that there is a compliance response, but there's still a lot of non-compliance, still a lot of underreporting of this foreign income despite the third-party reporting. So this is kind of puzzling, right? Again, if we return to our theoretical like frame here, like the third-party reporting frame, we say, well, why is that the tax authorities, that the taxpayers remain non-compliant despite the fact that they know the tax authorities know their true income, if you want. Okay, that's kind of strange, because our theory told us, well, the tax authorities should say, well, whenever we find a discrepancy, we'll audit it. And when taxpayers realize that, they will stop being non-compliant. So now to understand what is happening here, we will study like how self-reporting of foreign financial income shapes audit outcomes. Okay, so we're going to turn to the audit data and basically ask whether, compare people who have the same true foreign financial income based on these reports by foreign banks, and then compare those who, truthfully self-report and those who don't self-report, and see if there's a difference in the audit outcomes. Is it the case that, I'm more likely to be audited if I don't self-report my Swiss income than if I do report my Swiss income, and I'm more likely to be corrected? And again, so this is what we're going to do in the audit analysis. So the empirical strategy here is to compare taxpayers who are nearly identical in terms of their kind of background risk of being non-compliant, as determined by a lot of controls, so age and reported, so categories and reported income, self-employment. Actually, I also now in the results have a lot of controls for deductibles and kind of fringe benefits and everything that you can kind of say that looks a bit fishy. We can stuff that into regression and control for it. So we compare taxpayers who are identical in these dimensions. They are also identical in their true foreign income as measured by kind of how much do foreign banks say that I have of income, and in what country actually. So we condition on kind of also the bank country. But they differ with respect to their foreign income reporting. So again, people who have the same report, literally, and one chooses to self-report, the other one doesn't. And we'll ask whether the non-reporters face like a higher risk of audit and a higher risk of audit correction relative to otherwise similar self-reporters. Okay, and again, like what is our expectation if we come into this with our like this theoretical framework for thinking about third-party reporting, we would think that, well, if the tax authorities have received the report that I have foreign financial income and I don't report any myself, it should trigger an audit mechanically, right? I should have a probability 1, of being audited, and a probability 1 of getting a correction. So that's kind of one benchmark, at least, to compare the results to.
Yes.
Yeah, question.
Before you get to the analysis. So the tax authority did not communicate on how they would use these reports, and because I know, like for France, for example, they communicated, they launched an amnesty program for evaders.
Yeah.
But here they didn't.
There's no amnesty, so again, I'm less well versed in the South African context than I should be. So we have not come across any kind of major communication. I think I'm pretty sure they have not kind of pre-committed to doing anything specific, at least in terms of audits. So the audit data are comprehensive, but they are not kind of so detailed. So we just see when the audit starts, when it stops. We observe the total amount of the correction, and so. But the great thing here is that it really encompasses everything. Also, like the very, very lightest review. So basically, they never contact the taxpayer, but just kind of say there's a little flag here that we have to look more carefully at. So there are many, many, many audits here, and some of them are not even noticed by the taxpayers. And so we will just categorize, like based on this, like the duration of the audit that we see in the data. We're gonna categorize something we call like a full audit or like a more thorough audit. That is like if it takes more than 90 days to finish it. Most of these audits just take like a very few days to get done. So we have these 3 indicators for whether any audit happens, whether it's a full audit, or whether there's ultimately any kind of correction done in the context of the audit. Now, so these are all estimates of this differential risk of having a correction made if you are not self-reporting your foreign financial income relative to someone who has like the same background characteristics and everything and is self-reporting the foreign financial income. Yeah.
But his correction is not fines, or is it? I cannot tell you for sure. I should be able to know that, but at least they have in the audit they have increased your income, taxable income. If it's really just like a correction,
yeah.
then this is definitely a risk that someone would take.
Yeah.
Even if it's anyway, but
but
what you're worried about would be to be fined.
So I think what you are saying is something about the incentives. Yeah. I think that even. So regardless of like this penalty structure, like and so on, I think the theory still tells us there should be kind of a huge kind of differential risk of underreporting if the tax authorities basically have information showing that you are underreporting, right? And then you could say the next step is to say something about like the incentive structure of the taxpayer, and that will be governed by the penalties. And I'll look into that, but I don't have that right here. So this says there is a differential risk of being audited when you don't self-report your foreign financial income relative to a similar person who does. 15? Okay. It says, well, that risk is higher when your account is in a tax haven than if it's in another place. And it also says that risk is higher the larger kind of the absolute size of your underreporting. It does seem to actually, if you're in the top 1% of these discrepancies, then suddenly you get a much higher kind of differential risk of being of getting a correction. But I think what is worth noting here is the size of these estimates. So this is like less than 1 percentage point for the average kind of non-complier here, and even for those guys who are in the top 1% of underreporting, well, then it only gives them a 6 percentage point kind of higher risk of getting a correction. And this is like against the baseline of around 10% in the sample here, people who have foreign financial accounts. So there is an effect, but it's very, very small compared to kind of the theoretical benchmark. So we can take this number here, and then we can decompose it into three now differential probabilities. So this is the 1% over 4. So this is the unconditional excess probability of a correction, unconditional not in terms of covariance, but in terms of of the audit process. So you can see that actually there's a so this is the excess probability of being audited, of kind of being looked at all. And that actually is negative. Okay? That if I'm self-reporting my foreign financial income, I'm more likely to be looked at than if I don't. So I've been thinking about this for a long time, and it's very puzzling, I think, in a way, and it's very robust. It also holds if you use time variation, and it holds no matter what you do. So, and the only explanation I can find here is that actually the mere kind of self-reporting of foreign financial income raises some kind of a flag that makes you that you are someone who has something going on abroad that makes it more likely for tax authorities to look at you. Okay, so that explains, and this I can show that kind of in a kitchen sink regression, just saying conditional on everything else. Reporting some foreign financial income, does that kind of predict being looked at? And it does really strongly. Also in the pre-information exchange period.
Did you look whether this negative probability varies along the income, your place in the income distribution?
No, I could do that. Yeah. What is your expectation?
Like if you are at the top, no matter what you are declaring, you are as the government, I would be more likely to audit you.
Yes.
But if you are in the middle,
yeah.
You might go under the hood, but
yeah.
as soon as you declare you have
yeah.
accounts abroad, they will look for you.
Because it'll be a signal of actually being wealthier than you seem to be. Yeah, that's a really good point, I think. Anyway, so that was kind of the unconditional probability of being taken out for any kind of verification audit. Now, if you have been taken out for the verification audit, then there is kind of a differential positive probability of being looked at more carefully. So this is this bar here. Again, to have your audit then last more than 90 days. And if your audit is a thorough one, if it lasts more than 90 days, so there is a very strong or a much larger differential probability of having a correction done. All right, so that's the 8 percentage points here. So this is kind of decomposing this into these three parts, and it kind of tells the story of, well, actually I'm less likely to be looked at if I don't self-report. But if they start looking at me, well, then there's a bigger chance that they will kind of see that something is wrong, and they'll dig more. And there's a much bigger chance that then, if they start digging more, that they will then finally make a correction of my income. Okay, so I think we've been, the only thing I wanted to say is that this is kind of so this is all, of course, based on cross-sectional comparison. So that's, could there be something unobserved, that drives some of these differential probabilities? Of course, I cannot, I've really thrown in many controls, including more than I put on the slide. This is also, so the qualitative pattern here is also robust to using the time variation only. So basically using a longer period of audit data and having an individual fixed effect in there, and then saying what is the change relative to that baseline when I have a not self-reported foreign financial income relative to someone who does. All right. So this is where the empirical analysis kind of ends, where good news, there is a compliance response. It is not nearly exhaustive, that there is still a lot of non-compliance left, and we can kind of explain that, I think, at least approximately, saying, well, that is because tax authorities don't use this information efficiently, or they underutilize, you could say, kind of the fact that actually now they know how much income people have on their foreign accounts. And that's why it can still be kind of rational, and especially kind of if penalties are not very severe, to continue underreporting. So I think the question that then arises is like, what should we think about the audit policy of the tax authorities? Does it make sense for them like to do what they're doing and just like it seems that they're kind of taking out like the big discrepancies and looking more at them, or like, so what is a good, do we have a good framework for thinking about kind of what is the optimal policy in this context where clearly resources are not indefinite, right? They have a limited budget clearly. The information that they have is not perfect, it's clearly noisy. So what should we expect here? What is a theory that can guide us, like in terms of thinking about a good policy and also an equilibrium where, you know, that governs both like the compliance but also the enforcement behavior. And I think do I still have like 10 minutes or something like this? Okay, so we can quickly have a look at this theory that I think it might be a different paper actually, but it really, I mean, I think it also comes naturally at the end here because it's the empirics that have made me think about, you know, like about these questions. So again, I think I mentioned this briefly. So that the two key ingredients here in the theory analysis is like first that these third-party reports need not be accurate. So that is consistent with a range of empirical studies that, you know, that show what happens when tax authorities kind of extend third-party reporting from like the basic things like salary and dividends and so on to more esoteric things that then it often comes up as an issue that like these reports are not completely comprehensive or accurate. And it's definitely, we know from the Danish study, an issue in this in the context of this information exchange, that we just have direct evidence that sometimes banks report something that's not true. Yeah?
It is noisy, but do you think that it is also, there is a downward bias?
I think just because like, yes, that would be my guess, just because like if there's kind of incompleteness, that will kind of give a downward bias. But there are cases where banks report more than people actually have.
Okay, so but you have both.
You have both.
You have both.
Yeah, but probably on average, I think you're more likely to find kind of like underreporting by banks if you want.
Yeah, so a kind of implicit collusion with.
I mean, except that I'm not sure that it's always collusion. I think it can really just be because, you know, like they have to do all this work to, you know, to find out who is the true owner, and maybe they don't always do it properly, or yeah. Okay, and the other thing here is like this time consistency thing. That, you know, do we think of this as a Stackelberg where the tax authorities can just say announce whatever audit policy they want, taxpayers respond to that, and that's the end of the story? Or do we require kind of a NASH where kind of what tax authorities do also is optimal given what taxpayers do? And I'll go for the latter. Yeah?
And then I guess one important potential element is also how the return on audits, and this depends on the tax rate on this type of income and on the counterfactual. So how much could audits on other types of fraud could lead to in terms of revenues?
I can account for that. So that's in my the letter is in my model. Yeah. So I just want to say that kind of that this is so in the theory, like so people have thought about this a little bit in the past, and so the workhorse models of kind of optimal enforcement will ignore it, and so the workhorse models here will say, well, the optimal audit policy is to, within an audit class, within people who are kind of similar, I want to audit with a high probability people who report below a certain income threshold. That means that people who have true income above that threshold will underreport down to the threshold because they know they will never be audited. Whereas people who are below the threshold in true income will report truthfully because they know that they will be audited with a high probability. Meaning that in the workhorse model that ignores this problem, you get this paradoxical result where kind of no one who's evading will ever be audited, and everybody who's invaded will be, everybody who is being audited will be reporting truthfully. So kind of like this really, really kind of paradoxical result. So this is what we are trying to avoid here by doing Nash. Okay. Now, a simple, maybe I should kind of actually skip this. So there is like a framework here, and I'll just walk you through the results because I only have 5 minutes. I'll tell you what they mean. Result number 1. If the signal, so there's a model where the tax authority receives a signal about people's true income from a third party, for example, and precision here of the signal is the driving factor of the equilibrium, basically. It says, if the signal is perfect, if it's always precise, well, then there is an equilibrium in pure strategies where the tax authority says, well, whenever there's a discrepancy or whenever I get a signal that you are misreporting, I'm going to audit you, and the taxpayers say, well, then I'm never going to evade. So that's exactly kind of what I say, like our baseline thinking of like how this should play out works. Now, if you have imperfect signal precision, if it is ever the case that tax authorities get a signal that someone is cheating or someone reports too little and it's not true, then there is no equilibrium in pure strategies. Okay, then there is not, so taxpayers are saying evade, not evade, tax authorities are saying audit, no audit, then there's no longer an equilibrium in pure strategies because, if the agency audits with probability 1, then taxpayers won't evade, and so on. So you get the circle where you cannot kind of find an equilibrium. Now, so what happens then if you have imperfect signal precision is that you do get an equilibrium in mixed strategies. So this is an equilibrium where the taxpayer is randomizing. Sometimes they evade, sometimes they don't, and the tax agency is also randomizing. Sometimes they audit and sometimes they don't. And you can pin down kind of that mixed strategy equilibrium as a function of parameters like the tax rate, the penalty rate that you've mentioned a couple of times, and also this signal precision. Okay, and it basically says that that as the better the signal becomes, you are going to. I mean, it's going to say, well, there will always be this coexistence of third-party reporting and evasion as long as the signal is imperfect. In the equilibrium here, that is always like E is bigger than 1. There's some evasion. But as the signal precision converges to perfect, then the evasion rate will kind of converge to 0. So it's really going to say, the basic message here, I think, is that, a driving factor here is really like how precise the signal. If I get a signal that someone is misreporting, what is the probability that actually he is misreporting? And that's going to be the key factor that is shaping the equilibrium. Can I just, one last sentence here. And I think, so this is really, no, let's take your question first.
I was wondering if you get similar results if you had noisy enforcement of the fine.
Yeah. I could throw in other, yes, I guess I might, I maybe.
Because I can think, like, even if the signal is good,
yeah,
like, they might lawyer up and
yeah,
find some way to kind of
yeah,
get around the fine. And so
yeah,
I think that
okay.
It's just wondering.
Yeah, I should try to throw in more kind of stochastic things that and see what if you get the same. No, it's good. It's good. It's. I just want to highlight a couple of more things. So one is that clearly here there's a social benefit to commitment. So if the government was able to move away from this Nash to a Stagelberg, it would be much better off. Like basically evasion would disappear and you would expend less resources on audits. So that's kind of the last theoretical result. And yeah, all this is just robustness. The last thing I want to say is just that I think that this is kind of interesting how there's one basic metric here, kind of the precision of the signal tax authorities receive from third parties or elsewhere about taxpayer compliance that is like shaping this equilibrium. So this is not about kind of what is the optimal policy, it's just saying, well, there is an equilibrium where policy has to be in a certain way to like for this equilibrium to be sustainable. And I hope to be able to kind of confront that theory with data. So that's kind of something I'm hoping for, to basically go back to these audit data from, for example, Denmark, where you have like these randomized audits done every year. So you can see kind of by income category, you have like third-party reports and measure kind of how precise they are for different kinds of income. So when my employer says I have 100 of income, like how often is that not true? When a bank says I have 200 of interest income, how often is that not true? So for every income category, you can kind of measure this signal precision and then confront the theory now and say, well, is it true that, for the categories where you have more imprecise, signals, that then you get more evasion in equilibrium? So that would be kind of the next step here. Good, thanks very much. I'm done. Thanks for your questions.